Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Centrus Energy.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. And we really have to start with the financials because, even with this huge long-term story everyone's focused on, the company is, well, it's executing right now.
Yeah, the recent performance shows some undeniable momentum. If you just look at the third quarter of 2025, Centrus reported, $74.9 million in revenue?
Right, $74.9 million. And that's a really significant increase from the year before. It proves their operational leverage is improving.
And that Q3 result, it wasn't just a one-off thing, was it?
No, not at all. It was built on a really strong foundation. Full year 2024 revenue, for example, hit a very impressive $442 million.
$442 million. That's a massive 38% increase year over year.
Exactly. When you see that kind of sustained, accelerating growth, it tells you management is really capitalizing on these broader tailwinds in the nuclear sector.
So if we break that down, where did that revenue actually come from? The first big shift seems to be the low-enriched uranium segment, the LEU.
That's the one. That segment brought in $44.8 million.
Which is a solid 29% year-over-year growth for that product line. Pretty healthy.
It is, but here's the really interesting detail. A huge piece of that growth, about $34.1 million, came specifically from uranium sales.
And that revenue stream was basically zero in the prior period, right?
It was absent. So this isn't just about selling more of the same stuff. This represents brand new contracts, maybe an expansion of their trading or fuel assembly services.
It shows they're successfully diversifying, even within their existing market. They're not just, waiting for the big LEU story to materialize. They're making money now.
But we do need to balance that enthusiasm a bit. While net income was positive, I think it was $3.9 million.
Which is good. Shows they're profitable.
It does. But a core part of their business actually showed some real weakness. Separative work units, or SWU, revenues saw a pretty sharp decline.
A sharp decline is putting it mildly. It was a 69% drop, down to just $10.7 million.
Yeah, a huge drop.
So what's driving that kind of compression when, the rest of the sector seems to be on fire?
That drop is all about pricing pressures.
Yeah.
The global SWU market is just incredibly competitive.
So even though the U.S. is pushing for domestic production.
Right. The global market still has a lot of supply, historically driven by really aggressive pricing from, Russian and Chinese state-owned companies. So even a player like Centrus isn't completely insulated from that.
That's a crucial piece of context. It shows us exactly why their future really hinges on something else entirely, something where global pricing isn't the main factor.
And that, of course, brings us to the main event. The whole centerpiece of the investment thesis. Their competitive moat around high-assay, low-enriched uranium. This is the real story. Centrus is the only licensed U.S. producer of HLEU, period. The Nuclear Regulatory Commission gave them that license.
The sole domestic producer. That's not just a competitive advantage, that's a strategic one for the entire country.
It is. It goes way beyond pricing. It's about security of supply for the future of U.S. energy.
So let's define HLEU for a second, because it's not just a slightly better version of normal fuel. What is it, and why does that uniqueness matter so much?
So HLEU is uranium that's enriched to between 5% and 20%. The standard stuff, LEU, is only up to about 5%.
Okay.
And that higher enrichment level is absolutely crucial for the next generation of nuclear technology.
And by next generation, we're talking about advanced reactors, and especially small modular reactors, SMRs. Why can't an SMR just use the standard fuel?
It's really about physics, logistics. SMRs need HLEU because the higher enrichment lets them get more power out of a smaller core.
So the reactor itself can be smaller, cheaper to build?
Exactly. And critically, it lets them run for way longer without refueling. We're talking maybe 5-7 years compared to about 18 months for a traditional plant. To power this nuclear renaissance, HLEU is it's non-negotiable.
So Centrus isn't just making a fuel. They are basically producing the key that unlocks the commercial viability of all these future nuclear power plants.
That's a great way to put it.
So what does that mean in terms of market opportunity? Because this is where the numbers start to get, well, kind of astronomical.
They really do. The HLEU market today is tiny, maybe $0.26 billion in 2025. But that is forecast to just explode to an incredible $6.14 billion by 2035.
$6.14 billion. That's almost a 25-fold increase in just a decade.
A 25-fold increase.
That kind of growth, a market going from basically a niche to a multi-billion-dollar industry, that's exactly what the stock market is pricing in right now.
Of course. Centrus is positioned as the first mover. It gives them a monumental head start to potentially dominate that entire supply chain.
And they're built to scale, right? Which is hugely important.
It is. Their license allows for a capacity of up to 7 million SWU a year at their Piketon facility in Ohio. They're only operating at about half that right now.
So they have the room to grow, already licensed, as soon as those long-term LEU contracts start rolling in.
They don't have to wait years for more regulatory approvals. They just need to finish the build-out.
Speaking of the market reaction, let's talk about the elephant in the room, the stock price. This focus on LEU has led to technical momentum that is, frankly, just absurd.
It soared 297.1% year-to-date as of late 2025, nearly 300%.
To put that in context for you listening, the S&P 500 is up, what, about 18.7%, and the whole nuclear industry is up maybe 34%. Centrus is just in another league.
It's completely detached. It signals that big institutional money is making a massive, concentrated bet on this proprietary technology.
And management is being pretty smart about this, leveraging that high valuation. They announced, a $1 billion at-the-market offering?
An ATM program, yeah.
Okay, so raising $1 billion in equity, that sounds like major dilution. Why isn't the market punishing them for that?
Because it's a very smart use of capital. They're intentionally diluting shareholders right now to fund that future moat we were talking about.
So where's the money going?
It's earmarked for working capital, paying down some debt, but most importantly, for accelerating the technological investments.
Meaning finishing the expansion in the Piketon facility.
Exactly. Making sure they're ready to produce that HAEU as quickly as humanly possible. They're turning stock market enthusiasm into real physical infrastructure.
We should also probably mention the uplisting to the New York Stock Exchange back in December. That's a big deal for visibility.
Oh, for sure. It gets them in front of huge institutional funds, and it improves trading liquidity, which you need as a smaller company that's scaling up.
So looking at the charts, that incredible performance means the technicals are still bullish, moving averages are all trending up.
Strongly up. If you're watching the price action, the immediate breakout level is probably above those recent highs, near $464.
And a break above that would signal a new leg up in this whole story.
It would.
But for people who believe in the long-term story but are maybe a little wary of buying at these highs, is there a good entry point or a key support level to watch?
The key support level, the one that really needs to hold in a major pullback, seems to be identified around $243.48.
So holding $243.48 would confirm the long-term uptrend is still intact.
It would suggest the thesis is still very much in play, despite any short-term profit taking.
Okay, so we've laid out the massive upside. Now we have to balance the discussion. Let's get into the risks. The primary concern seems to be the company's leverage.
Yeah, that's the flip side of this high-growth story. This is not a financially conservative company. Their total debt-to-total capital ratio is at a very high 0.77.
0.77. How does that compare to, say, others in the sector?
It's an enormous difference. For context, their big peer, Cameco, has a debt-to-capital ratio of just 0.13. So that 0.77 ratio tells you Centrus is heavily reliant on the HALEU pivot being successful and on time. Any delays, any cost overruns at Piketon, that debt load immediately becomes a problem.
And the near-term earnings outlook doesn't really help, does it? Analysts project 2025 EPS at around $4.58, which is fine, but then estimates for 2026 actually dip.
They dip down to $3.70, and that's a bit of a red flag for the short term.
Right. It suggests the huge costs of the HALE expansion are going to hit the bottom line before the big revenue really kicks in.
It's a classic growth stock problem. The costs always come before the cash flow.
Which brings us to valuation, the other big bearish point. The metrics right now are, well, they're extremely stretched.
I mean, their forward price-to-sales ratio is sitting at 9.94x.
And the industry average is what?
Much lower. It's around 3.85x. So this stock is priced for absolute perfection. It's discounting years of exponential growth, which means any little hiccup could trigger a pretty big correction.
And you see that concern reflected in the institutional sentiment, right? In the options market.
You do. The options flow over the past 3 months is basically split right down the middle. 50% of it is distinctly bearish.
So that's big money hedging their games, or just betting that this valuation has gotten way ahead of itself.
It's both. It's confirmation that a lot of sophisticated traders are skeptical that the stock can just keep running like this without a significant breather.
Okay, so a clear standoff, high debt, and a sky-high valuation on one side.
Versus the HALEU moat and that 25-fold market growth potential on the other.
So what are the immediate catalysts we should be watching?
The first one on the calendar is the Q4 2025 earnings report. That's expected in early February 2026.
And that'll be critical for seeing if the traditional LEU business is still strong and for getting updates on HALEU milestones.
Exactly. Beyond the earnings report, we just need tangible updates on execution. Any news on the Piketon expansion, any major new long-term HALEU contracts.
Or even just confirmation that production is running smoothly. That's what the market needs to justify that almost 10x price to sales.
For sure. And the whole thing is being pushed forward by these powerful macro tailwinds you just can't ignore. The nuclear sector is hot. U.S. restrictions on Russian uranium are basically a gift to domestic producers like Centrus.
It's a massive structural advantage, and it's not just a U.S. story either. The global demand for HALEU is only going to increase as more countries turn to advanced nuclear to meet climate goals.
Right. They're sitting on the one thing everyone is going to need.
So if we connect all these dots,
The entire investment thesis comes down to that long-term HALEU market hitting over $6 billion by 2035. They have the only Western license, they have the capital strategy to fund it, and they have the macro environment pushing them forward.
So to sum it up, Centrus holds this really exceptional market position. That sole producer status is the engine here, and you could argue it justifies the high valuation.
You could, but you have to accept the high debt and the earnings volatility for 2026, because this is purely a bet on them dominating that advanced fuel market in the long run.
This is absolutely a multi-year hold then. You're targeting that big commercial turning point in 2026 and beyond when HALEU sales really start to ramp up.
And if you're looking to start a position, the thinking is you should aim for dips toward that strategic $243 support level to get a better margin of safety.
And here's the final thought we'll leave you with. You're not just investing in a stock here. You're investing in an essential building block for decarbonized power for the next century. Does the unique position Centrus holds mean that traditional valuation metrics are obsolete, or is this just an old-fashioned bubble fueled by future optimism? That's the question you have to answer.
Keep that $6 billion HAU market potential in mind as you weigh the risks. And don't forget to subscribe, like, and comment to Smart Wealth with Joshua for more analysis like this.